2022 has been a milestone year from many angles. Record inflation, higher interest rates, crashing bond prices, and the launch of single stock ETFs are among this year's biggest headlines. How can you position your investments to capitalize on these and other important trends? Ed Egilinksy with Direxion Investments joins us right after this. Welcome to the program. I'm Arianne Alcorta. It's great to have you watching. Be sure to subscribe to ETFguide TV and post your comments in our YouTube comment section below. Also, you can watch our original programs right here along with Amazon Fire TV and Roku, so don't miss it. 2022 ushered in some dramatic changes to the investment landscape. Besides record inflation and higher interest rates, it was also a year that offered big opportunities for energy bulls and bond bears. The launch of single stock ETFs has been another important development. Here to discuss that and more is Ed Egilinksy at Direxion Investments. Ed, great to see you again. Welcome back.
Thank you for having me.
Now, Ed, global investors poured just over $28 billion in leveraged and inverse ETFs during the first 9 months of 2022, according to data from Morningstar Direct. For perspective, this year's asset flows into leveraged and inverse ETFs has already been more than double last year's numbers. What do you think this trend in ETF asset flows is telling us about today's traders and investors?
To take a step back, Direxion's been a leading provider of leverage and inverse ETFs since 2008. This has been a great year for leverage and inverse ETFs and for the firm. We've had record net flows in 2022. We've had positive monthly inflows since the latter part of last year. So we're definitely seeing that momentum in the leverage and inverse space firsthand. I think the main reason for the increase in interest this year is the market volatility that we're seeing is more conducive to short-term active trading, and more active traders we're finding also have a risk-on mentality, which certainly you need in trading leverage and inverse ETFs.
Now, the top performing bulls ETFs this year have been concentrated in the energy sector. The Energy Bull 2X shares, ERX, and the Oil Services Bull 2X shares, ONG, are among the top performers. What trends in the energy sector have been driving the bullish move higher, and does it continue?
Well, it's been a great year for energy-related stocks, especially relative to the broader market. When you're looking at ERX or Gush or ONG, as you mentioned, these are all 2X daily reset of leverage energy stocks that give you exposure to the different areas of the energy market. One of the reasons for energy stocks performing as well as they've had this year has been due to supply constraints, whether it's ongoing geopolitical risk with the Russia-Ukraine situation, OPEC Plus limiting energy output, energy companies for the last couple of years, CapEx decrease in spending that's led to higher profit margins for energy stocks, as well as the alternative energy policy initiatives that have been more favorable to other sources of energy outside of fossil fuels, all have contributed to that. But one of the things to note is what's going on in November right now is interesting, in that our leverage and inverse ETFs are giving you exposure to different types of energy-related stocks, not the commodity itself. And there's been a divergence in November between crude oil, which is down pretty significantly, relative to the energy stocks. So it's important for your viewers to note, and despite the fact that it's been a great year for energy stocks and the trend has been your friend, mostly going up, that these are still designed as short-term trading vehicles for active traders, need to be monitored on a day-to-day basis.
Now, Ed, bonds had their worst year in about 4 decades, and that was good for bond bears. The 20-plus year Treasury bear 3x shares, TMV, and 7 to 10-year Treasury bear 3x shares, TYO, both delivered strong results. How do you explain the supersized gains of TMV and TYO in a year when most bond funds were negative?
Well, it's been a difficult year for bonds. We've had 40-year highs in inflation, and the Fed has been forced to aggressively raise rates. As a result of that, we have 3x bear products that could take advantage of interest rates rising, which they have this year. And that is TMV, that gives you daily exposure 3x to the TLT, or the 20-plus year Treasury. And in the case of TYO, that gives you exposure to the 7 to 10-year Treasury, so a little on the shorter end of the curve. So there's ways to participate if interest rates rise. But let's keep in mind also, this has been an unusual year. Bonds have rallied previous to this year for the last couple of decades. We've been in a low interest rate environment that's changing now. These are still designed as short-term trading vehicles for bond traders that have an opinion of which way interest rates are going to go, whether up or down. And the month of November has been interesting as rates have started to drop again. The inflation numbers have been coming in a little bit. The Fed may not be as aggressive with their rate hikes going forward. There's optimism there. And also there's a concern about a global slowdown, especially with the ongoing lockdowns in China. So our triple leverage bull, which is TMF of the 20-plus year Treasury, is actually up over 20% in the month of November. So my point being is, again, these are short-term trading vehicles for active traders, and you got to take advantage of that movement, whether it takes place, whether it's going up or down.
Direxion has also been a leading innovator in the ETF market, and among this year's industry milestones was the launch of single stock ETFs. Direxion unveiled 10 bull and bear single stock ETFs tied to blue chips like Amazon.com, Apple, Google, Microsoft, and Tesla. So what type of investor or trader do you think single stock ETFs could appeal to?
Well, we're just broadening out the spectrum of who leverage and inverse could be available to. We have broad benchmarks, and now we have single stocks. So it's the same DNA of those type of active traders. They still have to be cognizant of the daily reset of leverage, compounding after owning past one day. And these are path-dependent vehicles. The one difference here is there's additional concentration risk because they're just made up of a single stock. We have 5 pairs, 1.5 times on the bull side and a non-leveraged inverse on the bear side. We're seeing a lot of interest and the trading volume. There's been high turnover, as you'd expect with leverage and inverse ETFs. One of the things we're seeing with clients is that they're looking to trade off of some sort of earnings, pre and post earnings, or headlines on these individual stocks. For example, just this week, Apple, there's concerns about iPhone production and whether or not they're going to have to reduce that based on the COVID lockdowns, as well as Tesla announcing that this week they should have deliveries on their semi-trucks as well. So there are a number of ways that investors can consider using the single stock ETFs. One is if they don't want to implement margin and they have a short-term bullish view, they could do the 1.5 times bull. And for those that are looking to use the non-leverage inverse, some of the individuals might look to hedge out the risk of the long exposure that they are holding and don't want to create a taxable event. So they'll use an inverse as a hedge. Or if they want to take an outright position to be short on an individual stock, don't want the borrowing costs, want it in a packaged ETF, here's a way for them to participate.
Thank you so much, Ed. Now, one final question before you leave. What are some of 2022's biggest investment lessons?
Well, one is that inverse ETFs are in vogue during times this year. We've seen some bear markets in equities and fixed income. So if used appropriately and looked at as shorter term trades, inverse ETFs can have some value as they've had in 2022. We're seeing SOX-S, which is our triple leverage semiconductor bear, hit $1 billion this year. SPDN with the professional buyer, which is our non-leveraged inverse S&P 500. A lot of financial professionals are using it for clients to reduce the beta of their equity exposure or take an outright trade on the short side. In addition to that, the traditional flight to safety trades, bonds and gold haven't worked this year, but commodities have. As a non-correlated asset class. So people may want to look at our COM ETF, COM, which is a broad basket of commodities that's tactically managed, that could go to cash with an individual commodity. That's a 5-star Morningstar rating. Also, mega cap stocks may not lead this next rally in the markets. We're seeing a lot of interest in our equal weight NASDAQ 100, where the top stock like Apple within the NASDAQ 100 will have the same 1% weighting as the 100 stock, which now happens to be DocuSign. So we're seeing a lot of interest in QQQE. And lastly, for sophisticated short-term active traders, leverage and inverse ETFs are as popular as ever in 2022.
Thank you for your timely insights, and we look forward to seeing you again soon.
Definitely.
Be sure to visit DirexionInvestments.com to learn more about Direxion's ETF lineup and strategies for positioning your investments for the road ahead. I'm Arianne Alcorta. Thanks for watching. We'll see you soon.